Hello, good afternoon. Today we are with Hubble Smith, business reporter from the Las Vegas Review-Journal. We are at the Southern Nevada Housing Outlook 2007. And because you are exposed to so many different areas of our marketplace and our industry, what stories are you working on currently?
Stories I'm working on currently, the appreciation rate in Las Vegas, which as you know has dropped way down from those unrealistic 40% and 30% appreciation that we had a couple of years ago down to the 3.6% range. People are dropping their prices on their houses. You think that could be bottoming out pretty soon, and I know you personally are bullish on the market here. Also working on all the condo projects. It just seems every time you turn around there's a new condo project coming up, and I know Dennis Smith talked about that here, how 62% of the market is now detached, and that's going to go down to about half. It's a buyer's market right now. I know you're out there snapping up properties. They're available. They're at a I wouldn't say a cut rate discount, but they're probably about as low as they're going to go. When we look back 5 or 10 years from now, we're going to say, well, we should have bought now. I think we're closer to California, so whatever their market does, we do. Don't worry about what's happening in Indiana and Iowa and Michigan, where prices are going down and the real estate is flat. Look at California. We're right next door. We're still perceived as being a pretty good value, even at $300,000 houses. The price of land's not going down, and you know as well as I do with construction costs and the people moving here, the demand. I don't see prices dropping. I really don't.
Here in Southern Nevada, what you see is a very rosy picture for real estate in the long term.
I think so. Look at what's going on down on the Strip and the billions of dollars of investments that's going into this town. What could set us back? I'm not really sure.
Yeah, without something catastrophic, I tend to agree with you, Hubble, and I really thank you for your perspective. Thanks again.
Thanks,
thank you, Hubble. Thank you. A lot of people are calling what's happening now the mortgage correction. Last year was the market correction, and this year is the mortgage correction. But if we stay steady to the course as we did last year, I think we'll be in balance.
Well, I mean, certainly they're going to need to get with their real estate professionals, start talking to their lenders now to see what type of programs might be coming up. As far as what's available out there right now, we'll have to see. We're going to have to wait to see what type of programs the lenders are going to create. We know as far as investors and homeowners go, without having these other type of loan programs, 80/20s that we were familiar with, it's going to change things up on us.
But I think if they get together with a loan professional, they can give them sort of their loan physical and go in and they can have their credit report pulled, they can see where they are, they can do the whole application process so that they're in position that when these products come up, they are ready to go ahead and move forward. So I think it's a good time. First place to start would be with the lenders that they currently have loans with on their property.
I think we're becoming, for the first time ever, the National Savings Index actually dropped below zero, and that's very concerning. It's concerning for finance professionals, it's concerning for just individuals. I think the key is now just not more spending, but how to save. And like debt roll down programs, these Australian loans have just been recently introduced, where you can use your equity line and compound interest versus simple interest to pay down the 30-year mortgages, whether it's a negative AM, 5-1 interest-only arms, 7-1 interest-only arms, whatever the product is. And the 80/20s, I'm glad to see those go away. I don't think people should have been financing 100% all these times. And so if you can't put 5, 10%, 20% down on a home, then maybe it's a good time to wait or come up with other options.
I'm concerned about the negative amortization you brought up. I'm really concerned about negative amortization on top of everything else, and then some of the caps and the indexes I've seen being used. I think people really need to be very careful on the loan programs. Don't you agree that they're signing up for? I think some of the options could be pretty scary. They may be worse than what they're currently in.
And I think that the government has stepped in and they're taking a real look at it. You mentioned Fannie Mae earlier, Freddie Mac. They are staying away from purchasing some of those loans that even have a hint of problems.
Well, I was just thinking one of the biggest problems I see is the appraisal process. What are the appraisals going through, and what are the banks forcing? When you got in a down market, you don't find a bunch of appraisals running out there appraising things for maybe as much as they did last year. And then the banks are putting extreme pressure on those people, and whether you got any kind of financing, if it's not worth what you want to finance it for, you aren't going to get it financed. I would have thought we'd have a big refi. One time I was thinking, man, it looks like the things are in place for a big refi boom again. They go nuts like it has. We got an election year coming up. Interest rates are stable, maybe going down a little bit. But because of the appreciated values being diminished, that doesn't seem like it may happen as much as I thought it would.